Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 107. As always, joined by the three amigos, Keith Dicker, Patagucci Vest, Rich Diaz, Tom Brady, and Macro. What's going on? Keith?
Me?
Me. I had, so guys, we all, we're always going 100 miles an hour with everything. But I was really tired last night. I went to bed at 8 p.m., Rich. 8 p.m.
Wow.
Guess what time I woke up this morning?
5:30?
8 a.m.
What?
That's 12 hours, Rich. Look at the clock. 12 hours. I feel
It's a regular
like
shift for you.
I know. That's like, then I got my afternoon nap coming up here soon.
Jesus.
But
No wonder you look so good.
Oh, I feel great today. Look at my eyes. Look.
You look good for 68, man.
Yeah, it's really good.
It's the Noxema cream. If you put it on before nighttime, it can really help to hydrate your skin. How about you, Rich? You're looking pretty hydrated there.
I'm very hydrated. Drink lots of water at work. Very important. I might have to get up and go to the bathroom halfway through the pod. No, I'm good, man. Nothing going on. We're moving offices next week, so there's been a bit of a bit crazy around here. But same old. Reading that book we talked about last week, and
What, the UBI book?
No.
That's the fairy tale. That's not a proper book.
We'll get into that later.
That's the fourth turning that you're reading, correct, Rich? Fourth turning?
That's right. Reading Fourth Turning, paying attention to sports. It's the best time of the year. Baseball, football, hockey. Yeah, no. Otherwise, just ready to kick off the pod. Loads to talk about this week, so I think we should waste no more time and get right into it.
Well, we are our good buddy, friend of the show, Tiff Macklem. He held rates firm at, it was kind of expected, right? We didn't even do a Twinkie bet on this last week. So we knew, I guess we're all winners here this week. It held kind of as expected. Keith, I don't know, like I watched his press conference. I would say it was a pretty balanced press conference. Like, I think he's obviously trying to talk up the fact that, we're still going to do more hikes if we have to, the job is not finished. But like in reality, I think it's kind of one of the last tools he's got in the toolbox, so to speak, is to try to talk up markets.
Yeah, a couple. So first of all, I was actually doing a Twitter Spaces at the exact same time as the BOC presser. So it was something that was booked a couple of weeks ago. So, Rich, I broke my streak for consecutive central bank presser attendees.
I didn't know you were doing a Twitter Spaces. I didn't get the invite.
Neither did I.
Well, I was the guest. I wasn't the host.
This was your other friends?
This is my other group of friends.
I'm hurt.
Yeah, and I think I was like invitee number 9, I think, to get on it. But so I missed the exact conference. Oh, by the way, guys, apologize. I got to jump around here, but I do need to make an announcement before we jump and make account of this stuff. So for, we have the Toronto event coming up. We need to jump into that first as well, Steve. Maybe you
want me to tee it up, man? You're all over the place today.
You think
at 12 hours sleep, you'd be.
I know we're all it's typical Loonie Hour fashion. Why don't you tee up the event first, and then I'll say what I need to say, and then we'll go back to the Bank of Canada.
Yeah, the live event in Toronto is officially confirmed. It's booked. It's happening November 30th at the Dawn on Danforth, so East Danforth, for those of you that are local to the GTA. It's a cool venue. We're going to sell about 250 tickets. That's it holds about 250. So cool theater style. As usual, we take care of the first drink, provide, food, appetizers, live podcast. So it's gonna be an awesome event. So tickets, if you're listening to this episode, tickets are gonna be live on the Eventbrite. They're ready to go, ready for sale. So there'll be a link in the description in the show notes here to go check that out. On the addition to that, if you're listening to this and you're a business owner, business operator, We are looking for one or maybe two more sponsors for the live event. So if you're, wanting to get your business and brand out there to a wide audience, shoot us an email and we're happy to discuss options there. Heath, over to you.
Maybe Ottawa can, with their UBI program, can be a sponsor, and Rich could wear the t-shirt.
Over my dead body.
Okay, that's not my announcement, by the way. So linked to all of us coming to Toronto on November 29th, potentially Brent Johnson and myself, we're going to hold a private dinner for any investor who is a qualified investor. If you have an interest in that, just send me an email directly, and we'll let you know if we're putting it together. But it is something that we could be doing. So once again, if you have an interest in attending a private dinner and you are a qualified investor, send me a note, and we'll chat about that as we
Qualified.
go through.
Geez, more free plugs for Ice Cap, eh?
It's qualified. Yeah.
I think we should qualified, but
it's a regulation kind of thing that we have to deal with. But that's
you don't know
it.
that
Rich,
if you want
you have to have quite a few zeros. Let's put it that way.
Yeah, exactly. That's right.
But
zeros.
Anyways, Keith, after you derailed the whole conversation here, the Bank of Canada held rates. What was your takeaway?
So, I think it comes back to, was it a hawkish pause, or Steve, what's your word for it?
A panic pause.
Yeah, I like that one a lot better. What do you like, Rich? The hawkish pause or the panic pause?
I think hawkish pause is more appropriate, but panic pause is just legendary. I love that.
I know it sells more, but I'm actually more leaning towards Steve here with the panic pause. And because it's tied together with the other conversations we have today about what the news coming out of the Canadian banks and the economy and stuff like that. So, I mean, for, in the investment world, everyone was expecting a pause yesterday. No one was expecting a hike. If they were, they were just simply guessing and trying to become famous by being that one guy that did it. But the Canadian economy is slowing. You can dissect the inflation data, to support it in one direction or the other. But the overriding theme that I think right now the Bank of Canada is quite concerned with is that the economy is slowing. I don't know if it's slowing dramatically or aggressively or slow, but you do hit that slippery slope. But, we mentioned before that the central bank is always chatting with the big banks. So they always have their ear to what those guys are saying directly and indirectly. And I think we will get into it in a little bit, but the news coming out of the Canadian banks and their actions, it does suggest that Canada is going closer and closer into not a soft landing or not a no landing. That's two negatives. Not no. Yeah.
Going.
So we talked about before what our path is, our expected path, and it's going straight down that highway right now. I'm getting quite concerned with where we're going, and the Bank of Canada data points yesterday, it doesn't give us any comfort that we're going to be wrong, because we want to be wrong. So as an example, I'm sure, Rich, you have the data there as well, but you look at what their growth estimates are for the rest of this year and next year. And it's like we talked about before, there's never a recession coming. Like a good old business cycle, that's for chumps. That doesn't exist anymore.
Well, so I might have to correct you on that, by the way, when it's my turn, but keep going, finish up.
Go. What are you correcting me on? The chumps? We're not
chumps.
No,
we're definitely not chumps. But it's funny because you said that they don't predict a recession, but in their outlook or their forecast or what have you, there's a sort of a range. So that's what central banks will often do, or people who provide sort of forecasts, and they'll say, the range is the target is for next year is going to be 0.8, but their confidence interval is larger than 1%. And so implicit in that is a decline in GDP over the next year. So I thought that was kind of a funny wrinkle that I noticed in their monetary policy report.
Well,
that's a good point. I didn't see that because I was on Twitter Spaces.
There's more things to add to that, which is like they don't have. So obviously, Keith, to your point, they're not necessarily projecting a recession, but they are projecting very low and weak growth. But they don't have inflation getting back to target until 2025. So I think like middle of 2025, it looks like. But like to that point, right? I mean, everybody needs to take these like with a grain of salt. Again, if you're not projecting a recession now, if you do get more of a harder landing, obviously that's probably going to pull CPI down, further and quicker. So keep
Hey,
in mind,
Steve, have you noticed how the year 2025 is back in play? Because back in 2020, didn't the Bank of Canada not suggest, but explicitly, directly told everyone rates will not go higher until at least, what's it, 24 maybe?
It was the end of 2023. It was like 2024 or something. They were going to start hiking.
Yeah, I think they're just doing a find and replace with the year to switch it up. But so what were your thoughts then, Steve, overall? Like, were you from your desk, was it more encouraging that maybe the pain has stopped in the housing market?
I mean, I wouldn't say that. I think that I think housing is really struggling right now. I think like one thing I keep kind of pointing out to people, I know Toronto, I can tell you like unequivocally that Toronto is the hardest hit market in Canada. Like I would say by a decent margin. Vancouver's definitely struggling right now, but what we're seeing is really that the good houses, things that people want, move-in ready houses, right price point, those are still selling well. They're selling quick and they're selling for like, I wouldn't say top dollar, but pretty close to it. But then you have the rest of the market, which is like literally going no bid. And so, of course, when those houses go no bid, they're just not selling. They're languishing on the market for many, many months. Those don't show up in your on your price indexes. So on the surface, it might look like, you see the odd sale come through. You look at that median or average or the benchmark price and everything looks pretty good. Or it looks like prices are not really dropping. But in reality, like I said, there's a huge chunk of the market that is going no bid. And so that's kind of where we're at now. But I think to the Bank of Canada's, Rich, one of the things that Carolyn Rogers was asked there, the deputy chief governor there at the BOC, was, hey, housing, what's going on with housing? Why has it been so resilient? And she flagged housing supply as the main reason that house prices are holding up this cycle despite 500 basis points in rate hikes.
Yeah, we'll see. I mean, but you said, it's about the bid, it's about the index construction. We know that there's some faults in that. The things that I thought were interesting that we talked about the hawkish pause, but I think it's important to sort of read the language they used, which is, the governing council's concern that progress towards price stability is slow and inflationary risks have increased, and is prepared to raise the policy rate further if needed. So I think that the reality is my takeaway is that they'd like to raise interest rates higher, but for the reasons that we've outlined many times before on the pod, which is the fact that, there's lots of debt in the system, house prices or housing is under a lot of pressure. A lot of people's mortgages are tied to the short end of the curve, short-term interest rates. I don't think that they can. We know that they've talked about deficit spending before. They didn't explicitly mention that in the statement, but they did bring back the word population, which I thought was funny. So after, I think it was a 1 month or 2 month hiatus, remember they talked about it all summer. Then it hit the CBC airwaves, and then they stopped talking about it. And then now it's back on into the now it's back in the presser. Sorry, in the statement that they release every time that they make a decision or don't make a decision. The other things that I thought was interesting is they blamed Russia for food prices, which I thought was a little bit rich. I
thought it was the CEOs.
Anyways, I just like, come on, people. Which I thought, yeah. So that was kind of funny. I just thought it's a little bit of a tidbit there.
So who has the biggest budget allocated towards them? The Bank of Canada or the CBC? I'm serious. I don't know the answer.
But surely it takes way less than $1.6 billion to run the Bank of Canada, right? I have no idea. Sorry, I shouldn't have said that. I have no idea, but we'll have to look it up. Stay tuned for next week. But there's a couple more things I want to say, which was we alluded to like the forecast, but I think it's really important because with the policy, with the statement on monetary policy, they released the monetary policy report. And Steve, sorry if I'm jumping ahead.
No, go for it.
Which is, I think, was important is the official /third quarter gross domestic product by nearly half to 0.8, which is significant. Remember, if your population is growing a lot and your GDP, not and your real GDP growth is that low, it means we're all getting poorer. And so again, I think we're already in that recession, something we've discussed before. And then it says they also revised the growth for its for this year to 1.2 and next year to 0.9. So I mean, just more of the same. And we're going to get into another indicator that I think is interesting and that we've discussed many times, which is the CFIB. But yeah, it's just a situation where I think they want to cut interest rates, or at least want to be dovish. But because there are still so many inflation impulses from energy, from deficit spending, from population growth, they can't. And then they also cannot raise interest rates much more because Canada's a highly levered economy. We don't have any productivity growth, and we are, and all that leverage is in the housing sector, and people are getting squeezed. So they're what is it? Between a rock and a hard place. I think that's the situation we find ourselves in.
Tiff Macklem did flag in his press conference, in his speech there and Q&A period. He did flag productivity growth several times. So clearly they know it's a real issue in Canada.
Yeah. It has to be.
A couple other interesting comments here from Tiff, quotes. Keith, you like this one. He says, the path to a soft landing is narrow. In our new projection, that path is narrower.
I did see that. I did.
I
think they listen to the Loonie Hour, because we always talk about the path as well, right? The journey we're going to take, and
the path,
not Aerosmith, but journey,
Frodo. Who's
but for
Frodo?
some people, or maybe listeners who are not quite into the central bank talk and stuff, just to give you an analogy of what's in my view, what's happening at the Bank of Canada now. And this is like one of these classic or very bad boomer analogies that I'll make.
Boy.
I think it's a good one. Let me know what you think. Remember the movie National Lampoon's Christmas Vacation?
Yep.
Yes.
Were you guys old enough to see that then?
I don't remember it. Really,
I don't remember it either.
Remember the Randy Quaid character? Yeah. The brother-in-law.
He's the father, right?
No. Dennis. The dad is Clark Griswold.
Right. That's right.
Yeah. But Randy Quaid, he played this. I think he was the brother-in-law or distant cousin, and he had this huge mobile like RV, which we have to talk about RV portfolios in a little bit. He's parked out in front of the neighborhood, and Clark comes out one morning, and there's Randy Quaid standing up, and he has the big pump coming out of the sewage pipe from the RV, and it's just spewing this stuff down the drain. And Clark is like, what are you doing? What's going on? And Randy Quaid says, the shitter's full. The shitter's full. I think the Bank of Canada right now, it's full. They're, like you say, they're in a really hard spot. They can't raise rates anymore. If they raise rates, it's just going to tip the consumer over aggressively. The banks are already screaming uncle. We're getting indications of that right now.
We're going to get into that. But Keith,
but they have to come out and say that, hey, things are going as we expected, and this is what we thought would happen. But we can always raise rates again if we need to. That's where they are. They're in a really tough spot. So I think Randy Quaid is actually living in Canada these days. So maybe he should, move to Toronto and join the Bank of Canada, help those guys out. Got to flush the system, Rich. Flush it right out.
That was a horrible analogy.
I actually liked
I'm more confused. And I'm more confused than I was before. But I feel like it's one of those situations when your parents sort of threaten you. They know that it's like an empty threat. What they don't want, I think, is like the OIS market or the bond market to start pricing in rate cuts anytime soon, because that might, spur on some like speculation or whatever. But they can't raise interest rates for reasons we discussed. And so I think that they're just like, wait till your dad gets home, like that kind of attitude where they're trying to bully the market into behaving.
Daddy Tiff. But
anyway.
Well, they also mentioned, one of the reasons again for holding rates, which is what we've talked about on the show quite a bit, was, quote, the recent surge in global bond yields weighing on demand. So obviously the longer end of the curve doing a lot of the legwork for the Bank of Canada, clearly tightening financial conditions, which, I think for Canadians anyways, most apparent would be in your mortgage rates. Seeing the long end of your 3-year, 4-year, 5-year mortgage rates have obviously been pushing up.
There's really a little wrinkle in there. There's a little wrinkle in there because for the single most important consumer in the world, that hasn't affected them at all, right? The U.S. consumer, U.S. household, the most important household in the world until China eventually takes over, maybe. But for that 10-year bond yield doesn't.
That ain't gonna happen, man.
All right, whatever.
Bricks.
But
Cue, that's when we cue the panda in the room to come in and just like knock Rich in the head back and forth.
But
we need that's where we need the laugh track.
Can we get someone to dress up as a panda for the Toronto event?
That would be amazing, actually.
Anyone listening who has a panda outfit? Must be
okay. Well, wait a second. Let me just say it so that the 10-year bond yield surging to whatever it is has no effect on the U.S. consumer, in my view. Not really, not in the way it might have in other countries that have much more short-term liability. So, all right, Steve, get back to it.
Well, I think that I think ultimately we've covered enough of the Bank of Canada here. Keith, we also had the ECB, though. The ECB held rates today, as of this recording, Thursday.
Yeah, I know. I did listen to, or watch their presser. It was kind of similar to the Canadian one. Like there were no shocks from it at all. Actually, the irony was this one was held in Athens, and like Christine Lagarde and like they're most. Like she's a political animal. She's probably one of the best on the planet at being a political animal, and very charismatic and all that. But she starts the conference. Starts the presser. The first question goes to a reporter from the local country who's hosting it, because I think there are 19 countries in the Eurozone, or 20. I don't know what it is.
19.
Right now.
19.
The 19. Yeah, and anyway, so the Greek guy asked the question, and right away she says, by the way, I'd like to thank you, Greece, for bringing me such wonderful hosts, and also for Greece as a country and economy. You are now leading by example for the entire Eurozone, and we all aspire to be as fiscally sound as you. To which, I would have spit out my coffee at the time. You think about it. So if right now, if the Greeks are deemed to be one of the most fiscally responsible members of the Eurozone, it's time to sell that mother.
Okay. I can't speak to the fiscal position, but their industrial production has absolutely outpaced the Germans for a while, which I think is kind of an ironic. But
it goes back to anything. You always have to separate, the income statement, which is production and everything, from your balance sheet. Yeah. And I think the challenge with Greece and other countries and economies, that if you borrow too much money, at some point that breaks everything else. So I always laugh when people would say, oh yeah, Italy is outstanding if you exclude all the debt. It goes together. It goes together. But for the ECB today, guys, they had no rate hike. There was no differences. The exact same message to clue it up. They said, hey, we will raise again. We warn you, we will do it. But they're not going to do it. I think.
Are they done as well? Like, what's the market? I'm just curious where the market pricing. I think they've got the Bank of Canada has got 15% odds for another hike.
Yeah,
this calendar
effectively
year.
Zero.
Effectively zero. Yeah.
I think if the Middle East conflict between Hamas and Israel, I think that's going to accelerate dramatically any day here. And once that happens, I think euro is probably the most vulnerable currency out there right now. They literally get boxed in on all sides from an economic perspective. So I'm not expecting the Euro ECB and Eurozone to be an outstanding opportunity.
So Steve, they before you go on, sorry, they've all of the rate hikes have been priced out of the market. So now there's zero expectations, and there's a cut basically expected in the middle of next year. Now
this is for Canada.
Sorry for that. That's for ECB. Excuse me. Sorry, I thought you were asking about this ECB.
So which really means though, there's only one guy out there, one country they're going to hike again. They're coming up another hike. And we're talking about the Americans, and every time
Keith, I'm generally curious. Do you think the Fed, if you were a betting man, do you think the Fed's got what, one more, two more? What do you think they got?
Could be all three. You don't know at this point, because I think it's similar to 2018 in a way, in that they'll continue to keep hiking as long as they can. Because the reason they got stopped out in 2018, back then they were hiking 25 basis points, I think every other meeting. I think that's what it was. And eventually they had to stop because they created so much stress for the emerging market world and everywhere else. I think that's the exact same path we're going, because everyone else is now, they got the panic pause going on. It's going to be really difficult to continue hiking, but the Fed will continue to do it. And remember, everyone, that the Fed is the world's reserve currency. That's why Canada's different, the Europeans are different, and the Brits and all that. And I mean, if you're looking at currency movements over the last 3 weeks, the dollar is just this, we heard the concept with the wrecking ball. It's just knocking the crap out of everything. And if they continue go down that path, it will continue to do that. I mean, one thing that the challenge with Canada right now, I mean, I think a lot of people are asking about the currency, Steve. I think you brought that up earlier. And I think if, we're not providing investment advice in the podcast and all that, but if we have a normal economic downturn, and like this is probably the high for Canadian dollar where it is right now. So we're at 73 cents here right now, I think, in the December contract. I think we were at 78 maybe a couple of months ago. Is that about right?
Wait, what does that mean? You mean 138?
No, the inverse. So I'm looking at. So for
I
everyone
don't
else
understand
out,
what 78 means.
So right now the Canadian dollar is around 72 cents. If you want to round
Okay.
it down, I'm saying it was around 78 cents a while back. I think if we hit a normal economic downturn, Canadian dollar goes into you'll see a 6 handle in front of it. But the challenge, of course, is that this downturn, it just won't be specific to Canada. Like the Europeans will have it. Germany is in a death spiral as well. I'm we're well positioned for this right now, and we're having fun with it. But I think that if the Canadian dollar continues to weaken, so this is something that the Bank of Canada will talk about. All of a sudden, then with the weak currency, and your largest trading partner is the one with the strongest currency, it helps exports. But anything that we're importing, it's going to cause inflation to be kind of sticky. So who will Ottawa call in then to yell at? Will they call in the Fed?
The Loonie Hour.
Joe Biden, Sleepy Joe.
Joe's on the beach, man. He's not coming out.
They're gonna blame us, maybe. Hopefully, that'll be fun.
So Keith, I mean, a lot of people have been, obviously, like anytime Bank of Canada seemingly holds or does the panic pause, the Twitter replies all freak out about the Canadian dollar, and I get it, rightfully so. But I think you've kind of highlighted an important point, which is pretty much all the other central banks at this point are also on hold, other than probably maybe the Fed. And I just don't think it's realistic that anyone's gonna be able to keep up with them. And so, because I think, Rich, you might have some comments on this as well, but I think you have to kind of look at the Canadian dollar as a basket of currencies against a basket of currencies.
I think that's my view. I think we're not anywhere near like as vulnerable to Europe or Euro or the yen, which is, hitting 150. But that's, as Keith will say, that's because those other countries are even worse than Canada's situation. I think the Fed might be closer to being done just because of the change in what's happening in the yield curve. So we discussed the yield curve before, which is, let's say, you have different types of maturities for different bonds, 1 year, or actually probably 3 month, 2 year, 4 months, 4 year, 5 years, etc., all the way to 10 year. You can have a 30-year bond. I think I'm not sure that they do that anymore, actually. Anyways, and obviously the shape of the yield curve. So, what percentage, what your yield to maturity is for each of the bonds along that sort of you get curve. And for a while there, we were inverted, and I still think we are. But it's the shape and direction of those moves that matters a lot, and especially as far as predicting recessions and as financial conditions are concerned. And what we've actually seen over the last, let's say, 3 months or 2 months is the 10-year bond yield starting to rise and the 2-year bond yield, let's say, for argument's sake, is flat. And what that means is you're getting some term premium getting priced back into the market. And what that means, sorry to go on, but this is an important point here, and this is what we talk about at work all the time, is that if that term premium continues to rise, you don't necessarily need to be as hawkish on the front end of the curve, because that term premium starts to, curtail financial conditions, affects valuations of stocks, and that's what we're seeing. That term premium is now positive. For a long time, it was negative, so that's an important point. And I think that that's where you get That's basically the basis of the argument that, that Powell will continue to be hawkish, but they may be done if that term premium continues to rise.
We also call that it's a bull steepener. So if anyone is doing, finance related courses, and hey, the CFA pass marks came out this week.
Yeah, they fell
level
again.
3. Yeah, it's like
very
50.
hard. That's CFA level 2.
Or...
The bull steepeners in CFA level 2. That's what you learn there. But
it's in level 2.
What level is this guy again?
Me?
Yeah, he's got it right back.
Rich
there.
is like level 9.
No,
actually, mine is on the wall.
For him.
See
Don't make fun
see
of
that
me.
diploma back there over this shoulder?
There's only 3 levels, and I'm in good standing for now until they make me do ESG stuff.
So my CFA registration number is like 0014.
Yeah, you're
the OG.
Mine's in the hundreds of thousands, but no, but that's a really important. I think that's a really important point about the term premium. The extra return that you get for the number of years to maturity or the duration of your bond. And that's
I have something extra to say about the extra.
Go for it.
It's good. It's positive. So normally in a bull steepener, we're going down that path.
Okay.
Steve is rolling his eyes. He's like, oh God, here we go. But when that's happening, it's normally so people are selling long bonds because they rather take the money allocated, to risky markets, over equity markets and stuff like that. That ain't happening right now.
Right.
So right now we have this very unusual situation where, long bonds are getting mullered. The stock market is getting mullered. And so we have to appreciate this. This is a bit of a unique situation. So right now, just using the long bond as a proxy in Canada, this is down almost 40%. This is excluding coupons, but down about 40% since the peak in 2020. So that's a pretty dramatic decline. And the big risk, and I think we've all been pretty accurate with our views on the bond market, since we've been chatting about it. All of these, anyone who's holding bonds right now in a mutual fund of some kind or an ETF or whatever, the losses so far have been based on duration. So that's long-term rates going up. The next wave that we suspect will happen will come from credit spreads blowing out. Because Rich, you've been very correct in pointing out that credit spreads are okay. They haven't blown out yet. But if that happens next, all of a sudden, then you're going to have, not 3 years of losses in the bond market. Like it'll get extended out. So this is really something that we're watching. We're really interested in because we don't have any exposure to credit markets, but it could be setting up for a really one of these great opportunities of an investment cycle. So, even though there's lots of maybe heartache out there, it always creates opportunity if you have the liquidity available. And Steve, you were talking about liquidity earlier in the housing market. In fact, if you say, hey, there's no bid, that means there's no liquidity for something. So it is important to keep that.
Well, yeah, I mean, I'm thinking, we've obviously talked a lot about the carnage in the bond market, and we've gotten rates this high and nothing yet has really blown up, but it doesn't mean that balance sheets aren't impaired. Whether you're talking about Canadian housing or you're talking about, for example, Canadian banks, and so, we're starting to see obviously more and more layoffs at Canadian banks trying to shore up their balance sheet. And, Keith, we had, you pointed out this week, BMO selling their portfolio of RV loans. Which is
did you see that as well, Rich? Did you see that on the news screen? Yeah.
This is the second one of these, right, Keith? I think a couple of weeks ago it was like a auto loans, I think, that somebody sold.
Yeah, I think
BMO.
right.
I think BMO exited. I think BMO exited car loans and now they're selling their RV loans.
Okay. So I did hear, yeah.
But they both have 4 wheels, right? So can't you just all call them?
Some cars have 3 wheels.
RVs are like.
So I've been researching these RVs now for years. Like it's my dream to get one of those.
Come on, you can do better than that.
Man, that'd be awesome. We could do a Loonie Hour road show.
Oh, I'd love to. Like one of those Mercedes Sprinter, vans they have, and you get it souped up a little bit. But I can see me and Willis and Mrs. Icecap won't come. She's not into it.
We'll come.
Maybe
We'll
that's
join
what
you.
we should. Maybe that's
We
what we
should
should
do.
do with the Loonie Hour bank account. There, we should go and buy a distressed RV.
We go for the route. Actually, that's something we
We have a
could
nice
do.
paint job. It'd be a really cool paint job. We can barbecue off the back. Oh my god,
Put some
we
flames
can do
on it.
tailgating. We can do tailgating.
I call it shotgun.
Yeah.
Flames,
drive.
flames on the
Yeah,
side, some racing stripes.
But back to something a bit more. Actually, it's the same, but we're both serious on each one, right? Having a Loonie Hour RV versus BMO not having them. So when I think I tweeted this out earlier this morning, but banks are very different companies than every other company we have in our global economy. And what I mean by that, they provide credit for everyone else to do stuff. That's all it is. So they create money to flow around for people through lending. And what we're seeing now, the actions by banks, especially here in Canada, is that their lending is slowing. The cost of lending is rising. They are, as we just talked about, the RV portfolio, they're selling off loan portfolios. And you only sell off a loan portfolio for two reasons. One is if you actually need to raise capital, so you want to reduce your leverage and all that. Or two, you think, oh boy, all these yahoos that used their money back in 2020 to buy RVs, they're not going to be able to pay it back. So let's get this out. So you have that happening. And then at the same time, we're seeing these layoff announcements by banks as well. So banks are withdrawing from the economy right now. And it's at a very slow pace. People say, yeah, their jobs losses, there's like 3%, big deal. It doesn't matter. It's the signal that they're sending to everyone else. And it's been going on like this for a while. Because remember, we've been talking about the loan loss provisioning line item on their income statements over the last few quarters. We've been, I think we were first on that, right, Rich?
Right.
We were pretty good with it. Now it's all starting to tie up together here. So keep watching. If you see the Loonie Hour pull into the dawn on Danforth in a
That'd be amazing. But
let's RV.
Let's just link it back to sort of more of a sort of a holistic view of that, because this is just a sort of a signal. We always look at these like nuggets, like Hansel and Gretel picking up these little crumbs of data as we sort of walk down this path, this journey, right, Keith? And this speaks to sort of a mistake that I think we actually we made sort of last year, and just we've been talking a lot of the stuff that we got right. Well, one of the things that we got wrong is the pace at which a lot of this pain would come. And I think when the rate hike started, we were like, okay, that's it. People are just going to fold up and stop spending and what have you. And I think that there was a lot more sort of room in these balance sheets and in these cash flows for households and whatever to absorb this pain. And I think that whether it's the crappy retail sales numbers, which I think Steve was going to get into a little later, whether it's whether it's the RV situation, whether it's the weak housing market, we talked about debt service ratios and how they would rise. Well, and also just it takes, people are stubborn. I think you gave us a story, Steve, about how people in the insolvency lawyers or insolvency trusts.
Yeah, no, insolvency is like near and dear to my heart because I have a family that worked in that line of business. Yeah. So I just hearing the stories as a kid growing up and how people react and how they abuse money.
But anyway, I just wanted to say that I think we were a little bit early to that story. And I think that those debt servicing costs and the squeeze on people's household incomes and their savings running out. And I think that all sort of wraps up together into that story of slower growth, sort of weaker prospect, weaker consumer confidence, weaker business confidence. Maybe we can get into that a little bit. But yeah, it's sort of all the sort of the same little nuggets on that path, really.
Well, I think I think anyone in financial markets, I think this cycle I think has been humbling. I mean, it's certainly been humbling for me. I think that it's interesting just hearing all the smart people on Twitter having healthy debates about why the cycle hasn't turned down or why it's still going, and there doesn't seem to be any sort of real consensus. It's just like it's incredible that we've had as many hikes as we had and nothing has truly broken yet. But I think it kind of points to the unbelievable amount of stimulus that was pumped into the economy, into the global economy during the pandemic, that like we're still kind of coming off of that sugar high because it was just so overdone, and the direct transfers to households, the government spending, it was insane.
The
So
savings.
maybe it's just taking longer to work all that excess out of the system.
I mean, so like we chat with a lot of people, every week across the country, and the overriding message we're hearing is it's not one of, it's not that everything is awesome. It's that it is getting tighter and tighter. Everyone has the anecdotal story that it is really tough out there. So I think what's happening, everyone is just working harder. So if you work more hours, stuff like that, you do that to try to maintain your household income, or you're just pulling spending away from something else, to keep the main things going. But I'm not hearing, these great success stories for everyone out there. There are always going to be individual pockets of success, but again, I know I'm being negative with the outlook right now, but we've crossed this line where it does it feels like we're going down to the back end here into the end of the year.
Well, so can I jump in and talk about? Oh, sorry, go ahead.
Well, I was just gonna say, I think we should walk through, some of the numbers, which is, in Canada, you look at our Canadian retail sales, and again for September they came in flat, zero growth, which, just for those that are following along at home, you need about 0.6% growth on a monthly basis just to maintain the level of spending in the economy. Because think about, prices are going up, so you have to adjust for inflation, and you have to adjust for the record population growth that we have in this country. So you need to see retail sales growing about 0.5 to 0.6% per month just to maintain what you already have. So the fact that you have zero growth means, again, Rich, as you've highlighted for, since day one on this podcast, real per capita spending in this country is peaked, 4 or 5 years ago?
2018, 19, yeah.
I think it was 2018.
Yeah, that's right. Oh my goodness. It is actually 2019. It was 4 years ago. Crazy.
You've been doing this for 4 years?
No. It's a chart that I shared. Oh, by the way, someone else stole one of my charts. It's flat. But there's just another thing that I think, just going on that, more data that came out, which was the CFIB, which is the Confederation. The Canadian Federation of Independent Businesses. Anyways, they do a study every month, and they obviously ask independent businesses, and they ask about, labor shortages, management, time constraints, shortage of working capital, limited space. I'm not going to read them all. And for as long as I've been looking at this series, let's say the last 3 or 4 years now, shortages of skilled labor and unskilled labor have been the most pressing factor limiting small businesses' ability to increase sales or production. And I think it might have happened last month, but I missed it. And this month, it's insufficient domestic demand that actually is now in second place, which I think is sort of a really, really fascinating number, and also sort of corroborates our sort of negative view. And the drop was incredible. So it comes out monthly, and it basically, to quote them, the business performance dropped 1.5 points to 47.2, a very low reading for the indicator. So the only time you've ever seen worse numbers is obviously when the Corona lockdowns happened, and in 2008, 9, and we often talk about trends, and the trend is not your friend. It looks horrible, really. So that's another.
Speaking of acronyms. Index. Yeah. Speaking of acronyms, I think I have one that might be a solution to all the challenges.
Okay, go on.
UBI. Any thoughts on that, Rich?
Can I get into this, please? Not yet. Okay, not yet.
So on the on the retail spending, though, right? So zero. It's interesting because you look at U.S. GDP numbers that just came out today for Q3. Incredibly strong, but then you look at earnings this week. So UPS, right? I mean, delivering consumer good parcels around the world, horrible earnings. CP and CN Rail here in Canada, marking a noticeable slowdown on their end. Hasbro toys, saying sales are really weak heading into the busier holiday season. So, you know, you look at all these sort of large consumer good facing companies, and they're just denoting all this weakness in demand. Yet again, you see these GDP numbers come in higher than anyone's expectations, and everyone just says, well, clearly rate hikes haven't yet filtered through, or maybe the data is just incredibly lagging. I don't know what it is, but it really seems like it's really hard to square.
I think it's a combination of both. Remember, GDP is so we're already midway through Q4, and this data is for Q3. But those numbers are unambiguously good. Annualized GDP growth of 4.9% in the US. Personal consumption was 4, up from 0.8. You had durable goods orders were really strong, 4.7. Ex transportation were really strong. I mean, just across the board. The problem is the market's not speaking to that at all. You have we always talk about the S&P 500, which is dominated by 7 companies. I think it's like 25% of market cap. I mean, them. I don't need to tell them them, Google's and the Facebooks or whatever it is. But then you look at the Russell 2000, which is a smaller cap company, still quite large, billions of dollars in market cap, but much smaller. And that's continuing to make fresh lows. And that's maybe speaking to the sort of the disconnect between sort of these lagging hard data numbers and then the expectations of what's going to come next. Keith, did you have something to add on that? Because it's kind of weird and also sort of makes sense in a way.
Yeah, I think you touched on it. I mean, we've talked before that it was our expectation for equities to come off in the second half, and that's where we're going. And people say equities are forward looking and stuff like that. It is, but it's also, you have this greed factor all the time. So if it doesn't matter what you think the company might make in earnings, like we're not valuation guys. We don't believe in that. Well, watch the CFA diploma explode behind me. Poof, gone. But it's always our view that if interest rates are 25%, like, are you going to borrow 25% to invest? The answer is yes, if you feel you can make a lot more than 25%, right? So right now, with the action in equities, and people made a lot of money in the first half of the year, maybe 7 or 8 months, whatever it was. And now you're taking money off. You shoot first, ask questions later, and it gains momentum. It's like that snowball going down the hill. And again, like, how much further this will go right now, it may not be an index level. Maybe it's a time level that we need to go through. But there is, as you're pointing out, like, there's a huge disconnect between what financial markets are telling us, because the bond market is getting mullered, the stock market is getting mullered, every currency is getting mullered. It's something very unusual. Not unusual. Everything is synchronized. It's happening. Yet here's the Fed looking at a GDP number. As remember, if you look at the Atlanta Now data from maybe 4 months ago.
Yeah, we talked about it last week.
Yeah, they were expecting, initially it was like 0%, right? For Q3 almost. Like, it was a very low number. And the quarter ended at 4.9. That's, so if you're the Fed and they look at GDP, they put a lot of emphasis on it. So even economy growing at 5% in real terms, right? Because it's a real GDP number. And at the same time, a lot of data points, they're not too bad. Like, they're okay. And for people calling for the Fed that, hey, they need to cut rates, like, that ain't going to happen right now. Maybe later on next year, like, if something happens. But they have every reason to remain hawkish and raise rates. And again, I think it's a replay of 2018, but with a lot more drama, coming up. Yeah. And it won't be like National Lampoon's Christmas Vacation drama, because that was fun, right? That was cool. This might be something different.
Hopefully
Steve didn't
RV,
see that movie. Steve doesn't even grin when I share the name of that.
Hopefully
movie.
our RV doesn't get backlogged there too.
That's right.
What size should we get? Like, one of the extra length?
I want my own bed.
I'm a big fan of the top bunk above the driver.
That's a good one.
So okay, let's are we
move
going to
on.
do UBI now? UBI or
Well-
continue to talk about the RV that we're definitely going to buy?
Well, we've been flagging a few risks, which is obviously the panda in the room. So the CEO of HSBC was out this week warning that the world is, quote, at a tipping point on debt that threatens to spark a global reckoning after years of government borrowing binges. So that's HSBC, which is obviously pretty.
And by the way, they have a huge incentive to say that. Like if you're one of the biggest banks and your balance sheet is stuffed with debt, the last thing you want is a debt crisis, because it's not a good metric for your bonuses at year end. And just I think somebody else, I think people should realize as well, whether they know it or not, HSBC is the unofficial bank of the PBOC, so of China and the CCP. They get half their business from those guys. And you always have to look at them for what they're saying and not saying. That is not a Western bank anymore. That is a Chinese-focused centric bank.
You know, one of the things I'm kind of curious just to kind of keep an eye on is the ongoing currency devaluation in China there, and if that's going to result in a bunch of capital outflows.
I mean, the capitals have already happened. I think I read somewhere that we had the biggest capital outflow since 2016, as overseas funds cut their holdings of Chinese bonds in September. So
yeah, so that was a huge driver of obviously the foreign buyer boom here in Vancouver in 2015, 2016, Toronto as well. But to be honest, I haven't really seen any of that excess in the market today. So I'm always curious to sort of see how that might impact things.
Maybe they'll buy the RV portfolio and become mobile. Now, can we do the UBI? I can't wait to hear about the UBI. I'm
All
excited
right, Rich,
for the UBI.
I'll tee you up for this one. So for those that have been following along on social media, it's been a little bit blown out of proportion, but Canada, the Senate has proposed a universal basic income UBI bill. And so now it gets proposed through Senate. So the senator that proposed it was ultimately appointed by Justin Trudeau, and her, along with an NDP MLA, had put this bill forward. So basically how that works is the Senate has to essentially approve the bill. And if they vote and approve it, then it goes to the House of Commons for them to obviously vote on. So there's been a lot of concerns about even this being mentioned of the UBI. And so, I think Rich and I had both tweeted about it. And obviously there were some interesting replies. A lot of people seemingly have not learned their lesson during the pandemic of what happens when you start stroking checks to households and the 40-year highs of inflation that have since followed. But Rich, you've done more due diligence and research on this than I have.
Yeah, so I think what I promised was to sort of explain what UBI is, highlight some of the proposed benefits of it, and then explain to people why I think it's a terrible idea. So UBI stands for Universal Basic Income. It's a social security program where all citizens of the country receive a regular, unconditional sum of money from the government, regardless of their income or employment status. Now, a couple of things are really important is all citizens, and that we'll get to why that's important in a second. I was then challenged on Twitter to read a paper, and I actually read the paper, which I will hold up for you now, so you can see my tabs. The paper is actually a pretty decent
Look
paper.
Look at all the highlights on that
That's
thing.
right. I actually read it, all 36 pages of it, double-sided. And the paper is called, Is There Empirical Evidence on How the Implementation of a Universal Basic Income Affects Labor Supply? A Systematic Review. Now, it's really important because on page 7 of this paper, it says it's very difficult to evaluate UBI because of the fact that no complete and long enough experiences of the sample has effectively ever happened. So a lot of the people who claim that there are benefits to the UBI, and I'll read the supposed benefits in a second, are certain that there's this is going to happen. But the fact is it's never actually happened. And I'll tell you why, because I've said at the beginning, all citizens need to get paid. So the study was done on something called conditional cash transfers, which you guys are all familiar with. If you're unemployed, you show that you're unemployed, or if you're disabled, you show that you're undisabled, or if you're got, psychological issues or whatever it is, or if you're an old age pensioner like Keith, you just show your driver's license, you and then you get a certain money. And then there's unconditional cash transfers. All this stuff is called pseudo UBI. And then the benefits that this gentleman told me are long. So I was strapped in on all the potential benefits. No social stigma, primary earnings, spending more time looking for jobs, more maternity leave, birth weights of children increase, more schooling, hospitalization rates fall, less crime, home ownerships, more fresh fruit and vegetables consumed, less alcohol and tobacco consumption. That's an interesting one. Improved cognitive function, I mean, the list goes on, and the list is so long, it's laughable. And I would suggest that because it is the way that this study was concluded that makes that's really, really important. So, the paper goes on to say, although we have not found experiences on the application of UBI as defined above all citizens, there are some partial and limited partial studies that have occurred. And I can go over some ones that are right now, which I think are really interesting. And so basically the paper sort of reviewed some of these examples. Now, some of them actually make a lot of sense. So in Alaska, so maybe not everybody knows this, but Alaska has an incredible amount of oil. And every month, I believe every single citizen of Alaska or every resident gets $2,000 per month. Now, two things are important. Number one, that's not basic income. That's just a cash check of, I guess, I would love $2,000, but that's not basic income. And number two, the participation rate for Alaska is actually higher than it is for the rest of the United States, but unemployment is actually lower. So the claims that this paper make, which is about, labor supply, and if you pay people, will they stay out of the labor force, et cetera, those are necessarily quite dubious. Now, I'm not going to address the whole paper. I would suggest you read it. But there are some really, really important issues that I think are worth noting. Is that a lot of the claims on those benefits have to do with the fact that when these studies are done, it's because they give people money, a small group of people. So for example, in Finland, it was 2,000 people. In Canada, it was 1,000 people. In India, it was like several villages. And in Kenya, it was the same thing. They don't give everyone money. And why this is important is I'll get to the sort of the detractions from this, later on. But so that's the first thing. Second thing is, yes, it's true. If you give a small amount of people some money, everyone will feel better. Who wouldn't want $1,000 here or $1,000 there? If you're poor, if you live in Namibia and someone gives you $500, or if you live in, in Kenya and someone gives you $1,000, like, yes, you will improve your home. You will send your children to school. You will buy more fruits and vegetables. I don't think anyone who is against UBI assumes that that's bad for you. The point really is, there's no free lunch. So number one, it's the cost of funding. So one of the things that they gloss over in this paper, and a lot of people gloss over, is like all these experiments are done with outside funding. So the experiments in Namibia, India, Kenya, whatever, were paid for by private donors or be paid for by the IMF or all these other places. So yeah, of course, if you're poor and you live in a village and someone from the outside helicopters money into you, yes, you will improve your livelihood. And that's what we do already. I mean, that's what unemployment is. That's what, people get subsidies for electric vehicles. Like, there's all kinds of cash handouts that people get in our current society. UBI is not that. UBI is giving everybody a universal basic income, a amount of money that basically will purport to support them for their lives. Can I keep going, boys? Is that okay? Still going? We're almost there.
Some questions.
Sure.
So far, it actually sounds positive, right? I'm not.
I know it sounds positive because I was.
Imagine if the three of us pool our funds and get the RV.
Sorry. So anyway, so what
does that have to do with UBI?
Oh, come on, I'm almost done. Let me just keep going. So it's all good. So if you just give poor people money, that's wonderful. The problem is that's not what UBI is. UBI is not just giving people who are on dire straits cash so that they can feed their children or go to school or stop drinking alcohol or look for jobs. UBI is giving every single person in your society. So let's say everyone, I've seen people over the age of 18, in Canada, there's 40 million people, 32 of them are over the age of 15. So, so you're giving all these people, let's say $15,000, because I guess that's how much you need to sort of have a subsistence level of income or whatever. So then that brings up the question of cost of funding. So, that example I just gave you, that's 16% of GDP. How are we supposed to afford that? If you give everybody 10% $10,000 a year, that's 10% of GDP. So again, one of the big failings is how is it funded? And again, all those studies are usually from outside. People who don't have a skin in the game or who are wealthy nations or wealthy organizations give those people, and then they assess how those people are doing. And I'm not saying that if you give poor people cash, they won't feel better. That's not the issue. The issue is how will your economy react if you give everybody? And let's slow down. Sorry.
Just bring Rich back a bit in his chair. And let's look at Canada here specifically. So let's just run through and say everyone is getting, say, 15,000,
sure,
say $1,200 a month. Maybe is that quite it? But anyway, we go with that. Then you said, okay, what could go wrong with this? So what immediately jumps out to me are small business owners, and you're competing for labor.
So absolutely.
So the household income level or population who really benefits from UBI are really the minimum wage workers. Am I wrong? Or I think I'm...
Well, it makes sense initially.
Yeah, initially. And then, so I'm the small business owner, and all of a sudden, it's going to become even more expensive for me to hire people to come to work because they're already getting subsidized anyway. So now there's going to be another percentage of the minimum wage workers who will just say, I'm not going to work at all. So now all of a sudden you have a labor shortage at the level of, because small businesses keep the economy moving all the time. So I see it as a negative for small business owners. Their costs go up. So either then they have to raise prices to maintain their profit margins, or they just close up shop altogether as well.
Well, there's two things there. One is the incentive to work. And two is something called a crowding out. So what you're effectively doing is so a wage is just a price, and that price is basically the equilibrium between demand and supply, in this case for labor. And if you just pay lots of people to not work, you will screw with those theoretical curves. Now people will say, oh, that's not true, whatever. And and the evidence presented in this paper is a survey, which I thought was really interesting, where they basically ask people, if we gave you lots of money, would you work or not? And of course, overwhelmingly, everyone says, oh, of course I would still go to work. I'd still go to work. I would say, bullshit. If someone gave me $50,000, I would feel a lot less incentivized to work. I just would. It would be very, very difficult to I don't know, maybe. Anyway, so I thought that was really interesting.
So is this the ultimate, the pendulum swings back and forth, and I would argue on the whole socialism spectrum, we're pretty far. Does this mean we've reached peak socialism in the Western world, or is it going to go further?
Well, I can't speak to that, but there's two more things, boys, and I swear I'm almost done. But so the other thing I think is really, really, there's three more problems with this that I think are really important. One is inflation, and people say it's not inflationary. But again, those experiments were done on super small scales. They were given to a village in a country, 200 people in a city. It was not properly done. If you subsidize everybody, you subsidize nobody. All you do is you lift the price of everything, whatever percentage, and everyone just goes about their daily businesses. And so that's the lesson that, Steve, you outlined from CERB. You sure, the first mover might appreciate that they get to spend that extra money in the first week, but then everyone just lifts their prices, and just because you buy a microphone for $300, or next week it's $325, it's still one microphone. It's not that you haven't bought more for your goods, is that the money is worth less. So that's really important. Number two is it's the redistribution of wealth. The critics argue that it's the most effective way of dealing with income inequality. I've said this a lot. It's not about income inequality. It's asset inequality. That's the issue. And then finally, I would argue it's immoral. Why are you giving, Moneybags Keith the same amount of money that you're giving to someone who actually needs it? A single mother, a disabled a veteran, or what have you. And so like there's a lot of issues, and ultimately it does
to
not.
be clear, I don't think morals come into this.
I think it does, because that's their argument, right? I'm using their standard.
I think overall, though, to tie it up, if you get aggregate income is increasing for the country because of the free money that's going out, it doesn't increase aggregate supply. So therefore, demand is more than supply. Prices go up, and then what's the Bank of Canada going to do then?
Right. I mean,
the shitter's
I don't even know why this is
What are
even
they
a debate. We literally just ran through this basic experiment over the last 24 months, and it like this
But it
doesn't
was
even
called something different, Steve. If you put a different name on it with more lipstick, man, it looks good.
Guys,
Hey, Steve, wrap it up.
I know I need to wrap it up, but it's really really appealing to just say things that sound great are often terrible ideas. The problems with Canada are cost, as I see it, are cost of housing, terrible productivity growth, inflation, corruption. And in order to alleviate all of these issues, handing people checks does none of the things that it's purported to do. The only way that you can help poor people and emancipate the working class is through productivity growth. And if you listen to the Loonie Hour for long enough, the only thing that matters in life is productivity growth. That's how you help poor people. That's how you emancipate the working class. And that is how you help. I don't know what else. There's definitely.
I don't know, Rich. It sounds to me like it sure will buy a lot of votes coming up.
This is
anyways, there you go. Thank you for letting me do that rant. I apologize if I missed anything.
Thanks for putting up with Rich and his rant here. We'll call it Rich's Corner for this.
Do you know what I think, Steve? I think we kick Rich out of the van.
No, I promise.
You're out of the RV, man. No, we can't listen to that for hours on end when we're driving.
I tried to do it fast. You guys I tried to do it quickly. So if I spoke too fast, it's not my fault.
We do appreciate you reading those 35 odd pages.
37, double-sided.
So there you go. With despite all that, Rich, we'll have you back next week. And so there you go. As always, guys, just a reminder to wrap it up here. The Toronto event for November 30th, tickets are going on sale as of if you're listening to this podcast, they're on sale. So go and check out in the show notes, whether you're on Spotify, Apple, YouTube, etc. There'll be a link there to an Eventbrite page where you can purchase tickets on a first come, first served basis. And there you have it. We'll see you next week.